periodic system. And the perpetual system, each purchase is logged and each sale when a purchase excuse me, when inventory is purchased, when inventory is sold, there's a journal entry at the time. It's all recorded at the time of the sale. The periodic inventory system does not show um, the periodic inventory system records how much was purchased, and then we have beginning inventory, the amount of purchases, and then we have an ending inventory balance. And we take, if, we have our goods available for sale, so we take beginning inventory plus purchases. We have our total amount of goods that were bought or held at the beginning of the period. That's our goods available for sale. Then we know what our ending inventory balance is, and the difference is how much we sold during the period. So then that becomes our cost of goods sold. And we'll get to that at the end of the lecture today. But perpetual is recorded perpetually. That balance of inventory, if we took a look at the inventory balance mid-month, it would be accurate. The periodic inventory system, we just record the amount of purchases made throughout the period, and then we count up the inventory at the end of the period, and we make an adjustment for how much inventory was sold. And that's much more common in selling bulk goods, such as oil companies or agricultural bulk goods selling companies, so that they don't have to record every single transaction. Sometimes it's easier when there's so many transactions to just count up what's there at the end and then record an adjustment for cost of goods sold rather than a retailing business selling a whole bunch of like consumer goods needs to keep track of all their SKUs on a daily basis so they know what they have on hand. So that's much more common than to use a perpetual method. Um, and that uh, so we're going to go over the perpetual method first. That'll be the majority of the slides today, and then the periodic method at the end, because there's much less details to know for the periodic method. But both are on the homework and the quiz. And I have a video uh, for a homework walkthrough for both. So please watch those for some more detail on that. And right, this course is technically a hybrid course. So a lot of times there's more material than I can give you in lecture. And that's why I have those videos for you guys to watch. So that, and that's why the homework, that helps get you through the homework. Anyways, so then we'll go through a number of transactions for under the perpetual system for purchasing and selling inventory. So purchasing inventory is recorded as a debit to inventory and a credit to cash if we pay cash for the inventory, right? Because our cash goes down, inventory goes up, shows up in our general ledger as increase to inventory, decrease to cash. Then if we purchased it on account, it would be debit to inventory, credit to accounts payable. And the terms of the purchase are indicated on the invoice. That's the document that goes with buying or selling the goods. And it shows the date in which the transaction occurred. It shows the payment terms, also known as the credit terms, and it also shows the credit period and any discounts that might apply for paying early. And this is what an invoice looks like. It is, and it's important to be able to read these and know what the terms mean. And so The invoice date is January 5th, and the terms are 210 net 30. And we'll be talking a lot about those terms here because the um, the payment is due within a stated number of days after the invoice date, which is 15 or 30 days. And this would be described as N15 or N30, which means net 15 or net 30. That means the invoice is due within that many days. And it could also be written as N dash N of EOM or end of month. That means it's due at the end of the month. And in this case, the term was 2-10 and 30. That means they get a 2% discount if they pay within 10 days. And otherwise, they have to pay the full amount within 30 days. And then it has the amount of $3,000. It has the order date, which is January 3rd, 2028. The terms start on the invoice date. This is when the timer starts on the terms. And so this is a little illustration of the terms. So the invoice, they ordered it on the 3rd, but nothing happens when they order it. It matters when they actually get it. And they got delivery of it. It was on the 5th. So that's the invoice date. That's why that's the invoice date. And right, because it also has the shipping date too. But the invoice date is the date that we use for recording the transaction, not the shipping date. We'll get into shipping in just a moment. So then they get a discount of 2% if they pay within 10 days. So that's between January 5th is the invoice date. If they pay by the 15th, they get a 2% discount. And so 3%, $3,000 times 2% is $60. So they get a $60 discount. If they otherwise, they have to pay it by February 4th. And there's no penalty, there's no fee for paying late. But if you're constantly paying your vendors late, nobody's going to want to do business with you, right? Or they're going to be maybe worried about, are you going to be able to pay? And they might not grant such generous credit terms, right? Allowing someone to say, oh yeah, just order whatever you want, we'll ship it, pay us within 30 days. Like that seems like a pretty loose credit terms, right? And then if someone starts paying late, then they're going to be like, okay, no, you actually have to pay us upfront for this inventory. That's the ultimate punishment for these companies because companies hate having to pay for inventory timely, generally, right? It's having to hold the amount of cash on hand to pay for inventory is a huge startup cost of a business. If they have to purchase, like imagine if we're starting a business, paying a $3,000 for inventory, just having to have that cash to pay up front before we're actually making a sale, collecting the cash, paying for the inventory, that's a big burden. But you can imagine like that's why drop shipping is such like that's why that's promoted so much by influencers and things like that. Because what drop shippers do is they purchase the inventory on the 5th, they sell it on the 15th, they don't pay for it until the 4th. And so then they have this whole float where they've gotten the cash from the customers and they still haven't paid back the suppliers. And that's why it has no startup cost, essentially, because they're buying all the inventory on credit, they're not paying for it yet, and then they're selling it before they even had to pay the suppliers for it. And so suppliers, right, it's also a cost to them to have to like lend customers money, essentially, right? They're accepting payment later for the goods. They're essentially lending customers money for this. That's why they allow that's why there's a discount for paying early. And that's to get customers to pay them much earlier. And so 2% discount over 20 days, we can extend this into what the annual interest rate would be. And so what we do is we take 360 days divided by 20 days times 2%, we annualize that 2% discount over a full 360 days. That's a 36% interest rate that they're effectively punishing their customers with if they don't pay early, right? So in this example, Net Solutions is able to borrow money at 6%. Can imagine it as like a business line of credit or a credit card or something like that where they have a 6% interest rate and they can borrow that 6%, pay on day 10, and then hypothetically they're paying back the line of credit on day 30 when they would have paid for when the no discount due date is on day 30. So let's say that they borrow money on day 10, they pay it back on day 30. They're paying 10 days of interest, 20 days of interest at 6%. 20 days of interest at a rate of 6% is only $9.80. So they essentially save $50.20 by borrowing money at 6% to pay 20 days early to get a 2% discount on the inventory, which is a $60 discount on the inventory. But $3,000 at 6% for 20 days is only $9.80. And so that's why this sort of cash flow management is so important in retail businesses. And some businesses play the game much better than others. AutoZone has such a market strength with suppliers that they have agreements where they're not paying for their inventory until 60 or 90 days after they've purchased it. And they basically just keep all that money as the flow. Like that's free, that's essentially interest-free money for them that they were able to get with their market power. And so then that's working capital management. If you're interested in that, that's what you can look up to look more into that. But it's really an important way companies can make a lot of money. And you can also think of it as like Starbucks collecting interest on all the gift card revenue they've received. They get the money for the gift cards up front, and it's all just sitting in their Starbucks gift card account. And Starbucks has that cash. They're collecting interest on it. And the customers don't really care because they get double stars, right? So it's and then the stars expire. I do not really go to Starbucks that much. My stars always expire. I don't even get like an extra shot of espresso or anything. I guess that's why I have instant coffee in my office. But under the perpetual inventory system, the buyer initially debits inventory for the amount of the invoice. So when we record this discount, this 2% discount, how does it actually get recorded in a journal entry? So because when we purchase the inventory, we don't know whether we're actually going to get the discount until we actually pay the discount. And so we initially recorded at the $3,000. So we debit inventory 3,000, credit accounts payable, that's on the 5th, that's on the invoice date. Then when we pay it back on the 15th, on day 10, it settles the full $3,000 amount, so that cancels out our accounts payable for this transaction. But the cash that we pay is only 98% of the invoice, so it's $2,940, and then we reduce our inventory by $60 for the discount because it reduces the cost of the inventory that we purchased. So we're recording the inventory on our balance sheet at the historical cost that it actually took to receive. Getting this discount is not a revenue to us. It's just reducing the cost of our inventory. So we credit inventory to reduce the balance. And assuming Net Solutions does not take the discount, they just pay the full $3,000 amount on February 4th or day 30 of the invoice. And purchase returns and allowances. So, a buyer might request an allowance for inventory that comes damaged. uh, or defective and so the in both cases, the buyer sends the seller a debit memorandum for the reasons for the return. And this is just so that everybody has documentation over what's happening here. And this is an example of a debit memo. Basically, they sent this thing and it says, hey, your service network cards, this particular invoice at $90 a unit, there were 10 of them that were defective. And so we're not going to pay for $900 of this invoice. And usually then the supplier will issue what's called a credit memo in response. It doesn't really relate to debit or credit, but that's just what they call it in this particular process. And so the supplier will issue a credit memo and say, it's all good. You don't have to pay 900 because it was defective, right? And so this is the journal entry for from the buyer's perspective. The buyer issues they debit accounts payable by $900 and they credit inventory because the bill they have to pay reduces and then the inventory cost goes down because of that. So also here's another example. They purchased $5,000 of inventory from Delta Data Link terms 210 net 30. And the terms, this is just a framework for how the terms can be written. So if, for example, it was 215 net 30, then they would get the 2% discount if they paid within 15 days. And if the terms were 110 net 30, they would get a 1% discount if they paid within 10 days or net 30. So the first number is the discount amount at like 2%, then the amount of days to get the discount, and then net, and then the amount of days that the invoice is due net. If the invoice was due within 90 days, it would be net 90. And the inventory is returned with, so they purchase the inventory, they return $1,000 of the inventory, and then they pay on day 12, or they pay on the 12th, which is day 10 of the invoice, and they less the return, less the discount. So they initially, it's a debit to inventory of 5,000, credit to accounts payable. Then they reduce the accounts payable by 1,000 for the return, and then they pay it within the 2% discount amount. The 2% discount is only calculated off of the remaining balance of $4,000. And just note that if there is a freight cost, the invoice does not apply to freight. We'll get into that in a bit, though. So the discount here is $80, which is 2% of 4,000, which is the remaining from 5,000 minus 1,000. And it's important that you all know how to calculate these discounts because on the homework, it'll say what the transaction is in this format here. And you'll have to calculate how much cash do they actually pay? How do we record this journal entry? So if there's a cash sale there's under the perpetual inventory system, when we make a sale, there's always two journal entries, one for the sale and one for the cost of goods sold. And so we debit cash if we sell for $1,800, we debit cash $1,800, credit sales for $1,800. Then we credit for the goods cost $1,200. This cost will be given to you in this chapter, but in the inventory chapter, we'll go over on how to actually calculate how to assign a cost to cost of goods sold using first in, first out, or FIFO, or LIFO, or weighted average cost to actually calculate what's the ending inventory valuation and what's the valuation of the goods that were sold. But for this chapter, we're just going over a lot of just the mechanics of how are these sales recorded. And so there's the sale journal entry and the cost of goods sold entry. So we debit cost of goods sold, credit inventory for the cost of the goods. Um, Sometimes, a lot of times customers are purchasing goods with debit cards and credit cards. Those are recorded as cash sales at the time because the cash essentially goes to uh, the retailer's account at the credit card company direct, like instantaneously. And then those card companies don't do it for free. They're charging a fee, generally anywhere from 1 to 3% of the transaction, and that's recorded as an expense. So at the end of the month, they get their statement from Visa or MasterCard, and it says they charged them 4,150 in fees. So they just debit credit card expense for that amount, and they credit cash. So those are recorded directly just as an expense. It's not a reduction in revenue. It's an expense of the business. There's selling inventory on account. Instead of debiting cash, we debit accounts receivable, then we credit sales, debit cost of goods sold, credit inventory. Later, when it's collected, we credit cash and we debit cash, credit accounts receivable. There's also sales incentives, promotions, and discounts. And these are coupons or rebates that are offered to customers based on a certain thing. And accounting wise, there's two types of coupons. There are coupons available out there in the wild to the general public. For example, posting an ad in the magazine, right, that they can bring in the coupon, they can get 10% off. The retailer doesn't have any obligation to provide that until the customer brings in the coupon and gets the 10% off. At that point is when they are providing that discount. But if it's Menards and you get the mail-in rebate deal, that is an obligation of Menards. If you fill out that form, they have to send you the rebate. And at that point, that becomes a liability of Menards to provide that rebate dollars. Or if, you know, we're going to Walgreens and almost every time I go to Walgreens, they print out the receipt and it has dollar off your next purchase within the next 10 days. And I never come back to Walgreens within the next 10 days. So it's, mildly infuriating in that respect. But um, they have to estimate the proportion of people that will come back within 10 days and use that coupon. And that becomes a liability at that point. And so we'll circle back to that in just a few slides here. But the general coupons that are not provided as a part of a receipt or as a part of a mail-in rebate system, those are called point of sale coupons. Also, instant rebates are point of sale coupons. For example, Costco, they have instant rebates all the time. Revenue is recorded at the real price that the business is actually receiving for that revenue. So in this case, Wellborn Stores makes a sale of $45 and Becky has a $3 coupon. The journal entry sale amount is $42. That's the net amount of the sale. So the list price was 45. There's a $3 coupon. The actual credit to sales is $42. The debit cash $42. That's the amount that she paid. Cost of goods sold is unaffected by the discount. It's just the cost of the merchandise of $27, and that's given to us in the problem here. And this is different than if there is a coupon issued when the customer purchases the merchandise, because in that case, the business has to accrue for how likely is this coupon going to be redeemed. So in this example, we do that. We don't do this at every single purchase. We do this in aggregate. So in May of 2026, Grande Stores prints a $3 coupon for the next purchase of over $20 at the bottom of every receipt. So they have to make a purchase to get that coupon. That's why there's an obligation there. That's why there's a contract there. So these coupons can be redeemed between June and August. And then there's an expiration date. During May, during this promotion period, they sold 40 million in merchandise, which generated 6 million receipts. That's 18 million in potential coupon liability. But they're estimating that only 20% of the coupons are going to be redeemed. So they only have to accrue for that 20%. And we just make our best estimate at the time in accounting. That's, we don't have to accrue for the whole 6 million in receipts. We make our best guess, and it has to be like in good faith, best guess of 20% of the coupons. And then the cost was 21.5 million. And so we calculate our coupon payable amount at 6 million times $3 times 20%. That's our estimated coupons payable. And that reduces our revenue for May because that promotion supported May revenue. And under the accrual method of accounting, we have to record our revenues when they're earned, and we have to match our expenses to our revenues. And this is all a part of that. So we collect 40 million in cash from customers at the time. And then our sales amount is 36.4 million. And then our estimated coupons payable is 3.6 million. Then when these coupons get redeemed, it's not going to reduce our future sales. It's going to reduce our coupon payable liability. And then when we reach August 31st, when all these coupons expire, we're going to reconcile our liability account to zero. And that's either going to increase or decrease sales at that time. And then our cost of goods sold is the amount that they give us. And so the journal entries for when these coupons are actually redeemed. In May, let's see. So we calculate it by taking 20% of the coupons. So we take 20% times 6 million. That's 1.2 million coupons. The liability is $3 per coupon. So that's $3.6 million. Only 800,000 of the coupons are redeemed in May on 52.5 million of sales, cost of 28.1 million. So the journal entry to record this is the sale, right? The gross amount of the sale is 52 million, but they used 800,000 in coupons. 800,000 times $3 a coupon is $2.4 million in coupons. And that reduces the cash that we receive from the customers. But this sale is not reduced because we took the hit to revenue back in May. So now it's June, the customers are using the coupons. And so the revenue is 52.5 million now, even though the cash received is only 50.1 million now because the customers use the coupon. But we're reducing our liability as they exercise these coupons. And then the cost of goods sold is just the cost of the merchandise that's sold. There's no effect there. Then we hit the end of the period. And then so we started coupon payable as a liability. We started at $3.6 million. We reduced it by, now there's 3 months of transactions. In May, it reduced by 2.4 million. Other random transactions happened in June and July and August. And now it's August 31st. And the balance is the balance as of August 31st is 175,000. on the unadjusted trial balance. Now we have to make an adjusting entry for the expiration of these coupons. They all expired on August 31st. So what do we do now? We have to reduce it to zero because we still have this payable, but now the liability has been sufficiently resolved. We like the coupons are expired. We no longer owe customers anything from this. And so we debit coupons payable and we credit sales. And so that boosts sales for August. And that's because when we're making these accounting estimates, we make the best estimate that we can at the time and then adjust it later as necessary. And that adjustment is recorded in the period in which we gain that new information. Now we have the new information that customers only ended up using all but 175,000 of the amount that we accrued. So we made the best estimate in May so that mid-June we can give, updates to our investors on our earnings call. We can report earnings per share for the May period. And we can create financial statements for the May period early. And then in August, when we actually know how much it's accrued, it just gets this adjustment going forward. And generally, there's a lot of estimates that are rolling. The company is always going to use this new information to update their current estimates for the future for when they run the August promotion. And then let's say that instead customers actually used more coupons than we thought they would. Then the amount actually is a debit balance of $50,000. We have to reduce it to zero anyway, and so it's actually going to reduce sales more. So we debit sales, credit estimated coupons payable to zero out our general ledger account for coupons payable. And the accounting is similar for rebates. So an instant rebate, it's redeemed at the time of purchase. It just reduces the revenue on that date. Best example is Costco. Like they have instant rebates all the time. And I don't even look at what the real price is. I just look at after your instant rebate, your cost for this crackers are $15, right? So whether it's a coupon or whether it's an instant rebate, there is going to be a coupon payable amount like this. They're going to estimate how many people are actually going to mail in the rebate. Like I guarantee you, Menards has a rebate payable amount, and they estimate exactly how many of their customers are going to mail in the rebate, and they record it that way. Returns are slightly different because when customers return inventory, we get that inventory back, assuming it's not damaged. And each customer doesn't know when they buy it whether or not they're going to return it. But big retailers like Amazon, like Target, like Walmart, they know that an amount of their customers are going to return what they purchase, and they have to accrue for that because we're recording the sales in the period in which they're earned, and so we need to record the sales return in the period in which it's earned too, and that's the period related to the initial sale. And so in this example, so then that creates a customer refunds payable amount and an estimated returns inventory because there's two parts to every sale transaction. We have the sale, so we have accounts receivable and sales or cash and sales, and then we have cost of goods sold and inventory. And we have to reverse both parts of the journal entry when it's a sales return. It's a complete reversal of the transaction, assuming the inventory is returned intact. And so they're estimating that 5,500 of merchandise is going to be returned. And so the sales of $7,000 will be returned or refunded, and then merchandise value returned is 5,500. And so we have two journal entries to reverse both parts of these sales returns that we think are going to happen. A debit to sales $7,000, credit to customer refunds payable, debit to estimated returns inventory, credit to cost of goods sold. This is going to show up on the financial statements. Both estimated returns inventory and inventory are going to show up as inventory on the financial statements, but only physical inventory will show up in a inventory count, right? This estimated returns inventory is not in possession of the store. I mean, think about Toys R Us or something, right? A whole bunch of people are buying stuff for Christmas, and then the unhappy children return it all in January, right? Like they know they have a pretty good estimate of how much is going to be returned, and they have to accrue for that. So then when the inventory actually gets returned, we reduce our liability by debiting customer refunds payable, and we credit cash because we have to pay the cash back as a refund. And then debit inventory and credit estimated returns inventory as the inventory goes from this estimated inventory still in the customer's possession into our possession. And now it's in our inventory system. Now, if we did a physical count, like it would show up. And I think that this chapter is really fun because it's all real stuff. It's physical movement of goods. And it all does relate to some actual things that are going on with a business. And so this is a credit memo. Remember, we looked at the debit memo earlier, which is basically the buyer saying, hey, it was defective. We want a refund. The credit memo is the supplier acknowledging, here you go. Yes, you get a refund. And so see, it's the $900 for merchandise damaged in shipment. It's the same goods as in the previous debit memo. And so, auditors are auditing every part of this cycle. And so they're gonna, when auditing revenue is the most extensively audited account because it's the most risky account for auditing, they're going to be looking at invoices, shipping orders, payment detail. And then for auditing credit memos and stuff, they'll be actually looking at the credit memo and saying, oh, yes, verified, proper approval. This is the amount, that kind of thing. Not that it's relevant to this class, but it's consumed so much of my life that I felt the need to share. So that's what but it is relevant to accounting as a cycle, right? Like there's all these documents that are created that show this is what happened during the period. And then when something needs to be looked up because something goes wrong, it's all traceable back to the initial documents and the initial sales. So this is a summary of everything that can happen in the refund cycle. So we record our estimate for the refunds that are going to occur. So we reduce our sales, reduce our cost of goods sold, create customer refunds payable and estimated returns inventory as accrued balance sheet accounts. Then when the refunds are actually paid, we reduce our liability, we pay it out in either cash or accounts receivable, and then take the inventory from estimated returns inventory back into physical inventory. And then if the customer makes a return, but doesn't actually return the inventory, which if the inventory is completely damaged and the customer makes a return, for example, my mom got me a toaster for Christmas. I used it one time and it melted. But there was no inventory that came from estimated returns inventory back into inventory. It's a melted toaster. It's completely worthless. Whether or not, I can't remember if my mom actually gave it back to Walmart or if they just refunded it, right? But even if Walmart takes it, they're just throwing it in the trash. That's not going from estimated returns inventory to inventory. They're just paying out the refund and settling the liability. And then there's no example of this on the slides, but you can imagine if we reach the end of the return period, we're doing some zeroing out to make sure that the estimates are the most current, right? So if the refund payable amount would be adjusted back with sales to be the actual amount, and the estimated returns inventory would be adjusted along with inventory and cost of goods sold to arrive at zero once the return period has expired. So that was a lot. Anybody have any questions about coupons and returns? Cool. Freight terms. I promised we'd come back to shipping. This outlines when the sale is actually made. There's freight terms and shipping terms that determine when does the title or the legal ownership of the inventory actually transfer between the buyer and the seller. And there's FOB shipping point and FOB destination are the two most common items. In FOB shipping point, the title control passes from the buyer to the seller when it's transferred when it's shipped. So it's called when it goes to common carrier. For example, like as soon as it's loaded onto the truck, that's when the sale is made, if it's FOB shipping point. And what that means is the buyer pays for the freight. Generally, you can think of it as the person that pays for the freight, they're paying for it because they own it when it's going from one place to another. And it's really important because during accrual method of accounting, we record sale when the ownership actually transfers. And so if something takes 3 days to ship, it might not sound like a big difference, but for giant companies like Amazon that are shipping things in 2 or 3 days, that could be almost $1 billion in sales. That could be the difference between 3 days, right? And so it is really important when ownership transfers to be able to recognizing the revenue at the point in which it transfers. And that's going to be the same as the invoice date. They're going to make the invoice date the same date as the delivery date or the shipping date, depending on what the terms were. And so the buyer, excuse me. So if the buyer is paying for the freight, if it's FOB shipping point, the ownership transfers at the shipping point, the buyer is going to have a debit to inventory and a credit to cash for the cost of the shipping. And that's because paying for shipping increases the cost to get the inventory to where it needs to go. That increases the total cost of the inventory. And so that gets capitalized as inventory. That's really as part of the cost of the inventory. For the seller, it's going to be delivery expense. So if the seller is paying for shipping and the title passes when it gets to the buyer, it's going to be debit delivery expense, credit cash. The seller is purchasing the shipping. There can be other shipping terms. For example, for grain or other goods that are like really bulk goods shipped by rail, a somewhat common other shipping term is FOB Chicago. And that means that the control transfers in Chicago. Whenever the train gets through Chicago, that's when the revenue is recognized. That's when the ownership transfers. And conveniently, Chicago Mercantile Exchange is one of the main valuation points for grain for that reason. And it's also where the rail companies switch from BNSF and Union Pacific on the West Coast to CSX and Norfolk Southern on the East Coast. And so it also ships who's paying for the shipping too between the buyer and the seller. They're right. So there can the free on board point can be any point between the buyer and the seller, but that's the point in which the control transfers and who's paying for the shipping transfers. Um, and you can imagine how creative they can get with it when it's like international shipping by vessels of large commodities or container ships. Um, so, a few examples here. Uh, the company purchased Net Solutions purchased merchandise from Magnet Data on June 10th for 1250 or for $1,200 terms FOB shipping point. And because it's FOB shipping point, Net Solutions is the buyer, they're paying for the shipping, so they paid $50 for shipping. And so there's the journal entry for inventory, you know, um, debit inventory, credit accounts payable, and then debit inventory, credit to cash. And that's because you can imagine they're paying $50 to FedEx or whoever to do the shipping. And then the inventory balance that they keep track of this. This is an example of an accounts payable subledger, accounts payable Magna data. They want to be able to keep track of every single vendor, how much do they owe and how much have they paid, right? And so it's all recorded. They're going to have an individual account set up in their accounting system for every vendor that they have to pay. And in case this was for FOB destination, this is also from Net Solutions' perspective, but they are selling inventory on account for $700 terms FOB destination. Cost of goods sold is $480. They pay $40 in freight, and they're responsible for that because it's FOB destination. They owned it during shipping. And so it's going to be debit accounts receivable, credit sales for 700. The cost of the goods was 480. So debit cost of goods sold, credit inventory, and then debit delivery expense for $40 and credit cash for payment of the delivery expense. And the seller might prepay for the freight even if the terms are FOB shipping point. But they're not doing this out of the kindness of their heart. Like they will add it to the invoice. And so in this case, they're paying, they made a sale, $800, terms FOB shipping point, and they paid freight of $45 and added it to the invoice. So this is from the seller's perspective. It's a debit accounts receivable, credit sales, debit cost of goods sold, credit inventory for the amount of the sale. And the shipping is a debit to accounts receivable of $45 because they increased the bill by $45, but it's not revenue to them. They were just facilitating the shipping. They have a relationship with the shipping company or whatever, and it's just easier for them to pay for the shipping. And they just add it to the invoice and collect it from the customer. And so then they pay cash, so it's credit to cash, $45 for the shipping, and then debit $45 for the accounts receivable because they're just adding it to the invoice. But it's not a revenue or an expense to them because it's the responsibility of the buyer and they are the seller. So they're just adding they're just sort of facilitating that payment, but they're just adding it to the invoice. And so this is everything that can happen. It's general flow of journal entries in these accounts. Inventory, debit for purchases, and then crediting cost of goods sold reduces the inventory, and cost of goods sold, of course, increases cost of goods sold. It's reduced for adjusting for estimated customer returns because that reverses the sale and reverses the cost of goods sold. The adjusting entry increases estimated returns inventory, and then as customers return inventory, that reduces the estimated returns inventory and puts it back into physical inventory. And then freight for purchasing merchandise FOB shipping point, that's added to the cost of the inventory because that's the cost to get the inventory into possession. And the purchase returns and allowances That's when the business is returning inventory to the vendor. Like that's going to reduce that buyer's inventory when the buyer returns it to the vendor, right? So they're sending it back, so that's going to reduce inventory. Lots of journal entry examples. I want to get into some other, I want to make sure that we get to some other items. So I'm going to skip a few slides as we go here. Sales taxes and trade discounts. Sale of merchandise often involves sales tax. When the sale is made on account, the seller just adds it to the invoice. For example, if sales tax is 6%, they're just going to add, so the sale is $100, and so it's credit to sales $100, credit to sales tax payable for $6 because they owe that sales tax to the government. And then they add it to the accounts receivable, so debit accounts receivable $106. Never miss those payments. The government will shut down a business within like a month if they don't make their sales tax payments, especially if it's liquor related. It is much better to miss income tax payments than sales tax or payroll tax payments. If you're ever in that situation, question what you've done to get there. But know that income tax is much more forgiving if you miss a payment. But not file. Don't ever not filing is a crime. Not paying results in cash penalties. Just felt the need to say that. I don't know why. But anyways, when they actually pay the tax, when they actually make the tax payment, that they're going to reduce their liability, debit sales tax payable, credit to cash. So there's also trade discounts provided, which are also like bulk discounts. When a company is selling a lot of inventory to really important really important customers, such as the government, such as very big businesses, they might offer a bulk discount. This discount just directly reduces the amount that's recorded for the sale at the time of the sale. So they just record the sort of the real price that they're giving to these important customers. There's no special account for trade discounts or anything like that. It's just recorded. They just record the net amount that they're actually charging them. And think of this as like Walmart, they have their headquarters in Arkansas, and retail, wholesalers from all over the country and the world go there to pitch their products to Walmart, and they offer these discounts. Both Walmart and their vendors are going to record the actual price that's agreed upon. They're not going to record anything special for trade discounts. So, for example, if the terms are 115 net 30, that's going to be a 1% discount if paid within 15 days. And I'm just skipping these examples because we need to get to the periodic method. If credit cards are used, right? So we have four different invoice, 4 different types of sales that are made, and each one has the amount that was the amount of the sale, the amount of cost of goods sold. So we have a record for each one for recording the sale, recording the cost of goods sold, because this is the perpetual method. We're recording as we go. Then some of these amounts, such as this was American Express, this was MasterCard and Visa. They were credit card sales. And then eventually at the end of the month, National Clearinghouse Credit sends them an invoice that says, hey, this was the servicing fee that was paid for these transactions. That's an expense. So we debit credit card expense for 13,450 and credit cash for 13,450. So that's not a discount, right? That's an actual expense of the business that shows up on the income statement as an expense. It does not reduce revenue. These are some examples here of, accruing and using coupon accrued coupon liabilities and sales promotion liabilities. When determining the amount to be paid on invoices, this is really important for the homework. We have the initial merchandise invoice amount, any returns and allowances that are given, the amount of freight that was paid for by the seller, and that's amounts that are added to the invoice. So they're all, um, it says each one of these, whether it's FOB destination or FOB shipping point. But for these two, where the freight was paid for by the seller, it was FOB shipping point. So the buyer is responsible for that. That's added to the invoice. The 210 net 30 or the 110 net 30 discount, that does not apply to the shipping amounts. Um, so for example, to calculate for item B here, this second one, the initial amount was 12,800. There was $2,500 in returns. And so the terms were 210 net 30. It was paid within the discount period. And so we calculate 2% off the net amount, which is 2,800 minus 2,500. So 10,300 times 2%, that's the discount, times 98%, that's the cash that actually was paid for the sale. Then we have to add the $300 in freight because that did not apply to the discount. And so then the total amount paid is 10,394. We'll come back to some of these examples if we have time later. If there's sales tax, we record a sales tax payable amount, and then we record the the sales tax payment as a reduction of the sales tax payable, and then a credit to cash at the time of the payment. There's a number of adjusting entries that happen at the end of every period for retail businesses, inventory shrinkage, and customer returns and allowances. So we went over the customer returns and allowance accrual, the coupon accrual at the end of the period when they were estimating how much is our liability for returns and coupons that we know are probably going to be made in the next quarter. They also make an inventory adjustment for shrinkage. And it's always a hot topic on Target and Walmart's earnings calls is what was the shrinkage this quarter? They count up all the inventory at the end of the accounting period, and usually it's less than the amount of inventory that should be on hand. And that's because of shoplifting. Inventory shrinkage is essentially, most of the time it's shoplifting, but sometimes it's just inventory gets damaged and thrown away. And so that gets, you know, shoplifting, employee theft, or errors is the loss of inventory amount. But that has to be counted up and recorded, especially at the end of the year. But sometimes it's done in the middle of the year as well for a continuous count of what inventory is there. Um, I I happened to be at the Walmart Elk River during inventory day this fall, and there were stickers on everything, counting up everything. And I wasn't there for like my job. I was just trying to shop. I was, but it was fun to see, right? Accounting in the wild. Um, and for giant companies, I'm pretty sure Walmart This is over $1 billion in shoplifting that happens every year, which is that's I mean that's wild. And so how they calculate this is they take the account balance of the inventory, what they should have on hand. They count it up and say, okay, well, we should have 63,950. We actually counted up, we have 62,150. We record inventory shrinkage of 1,800. So we debit cost of goods sold and credit inventory because that is added to inventory shrinkage. It's expected in the normal course of business for these retailers. And so it's recorded as the cost of inventory. It really is just a part of their cost of merchandising inventory to people. So, and it's recorded as part of cost of goods sold. And I've been a part of a number of these of inventory counts for my job, probably over 20, maybe even 30 as a part of um, doing this. I haven't run into major problems. There have been a few times where it's mostly a part of disorganization than anything, than a part of inventory shrinkage, such as this, because I haven't done it at a major retailer. I've mostly done inventory. I've gone to gas stations and like measured how much gas they have in the tanks, or gone to like grain silos and measured how much grain do they have. And it's pretty cool. You get to actually go and visit all the clients and see what the inventory is. And these facilities can be massive, absolutely massive. And if the shrinkage amount is large, especially in comparison to the total amount of sales, it's disclosed generally in the notes to the financial statements. So Walmart and Target will always have something in their notes to the financial statements. This was the amount of shrinkage that we had, and it'll be on their earnings calls too. We already went over estimated refunds and returns. The financial statements for a retail business, like we looked at earlier in the simplified example, they're going to have sales, then cost of goods sold, then gross profit, all shown at the top, then operating expenses. And they might, depending on how material these expenses are, right, they're going to have selling expenses, administrative expenses, and those are going to be subtotaled as selling and administrative expenses, and then operating income and total operating expenses and then operating income will be disclosed as a part of that. And then other revenues and expenses, such as rent revenue and interest expense, that's unrelated to the everyday operations of the business. So that's not included in operating income. That's included in net income at the bottom. For example, if a major retailer like Walmart or Target, they're collecting interest from their bank account, like they just have interest income from their balance, that's not going to be related to sales. And the sales is really what investors care about because that's related to the actual operations of the business. That's what they've generated by being a retailer. Any of this other revenue and expenses are more ancillary. And also, when judging an operations manager or the chief operating officer or something like that, they're going to be looking at operating income as a metric for them because that's what they're responsible for. They're responsible for selling inventory and managing the selling and administrative expenses, which is also known as SG&A, selling general and administrative expenses. And so this is how it'll appear. So you have sales, cost of goods sold, gross profit, selling expenses, administrative expenses, total operating expenses, and then operating income. And then these other revenues and expenses are shown separately at the bottom. This would also be taxes are generally other revenue and expense, but generally disclosed separately because that's not something the business can really control. And so that's a lot of times banks, especially, will look at interest or earnings before interest and taxes, or sometimes earnings before interest, taxes, depreciation, amortization, or EBITDA. It's another metric that they show to take out items that they don't really consider fundamental to the operations. And so they're not going to judge a business based on that for valuation purposes or cash flow purposes or credit worthiness or solvency, that kind of thing. And closing entries really follows the same process as um, a service business, except for now we have another expense in cost of goods sold. That's the only difference in the closing entry process. And it's just closed out just like any other expense account. And our metric this what we're looking at this week is asset turnover ratio. That's calculated as sales divided by average total assets. And we get a number, which is how many times did our total assets turn over during the period. Uh, we get our average total assets by taking the beginning of year assets plus the end of year assets divided by 2. We get our average total assets. And that's because balance sheet accounts are as of a particular date, right? Balance sheet is as of December 31st, 2025. But the income statement or total sales, that's for the whole year of 2025. And so to approximate a relationship between balance sales and something on the balance sheet, we have to take the average amount. So we're taking average total assets throughout the year. And what this shows is how efficiently is the business managing its total assets and or using its total assets, and how capital intensive is the business. So if the business had $10 in sales, average total assets of $1, the asset turnover ratio would be 10, which is better than if the asset turnover ratio was 5, because assets have to come from either liabilities or owner's equity. And liabilities, the cost of having liabilities is interest expense, right? Because we owe money interest on liabilities. And the cost of capital for equity is dividends or whatever returns equity investors are expecting. And so it's important to use assets efficiently to generate sales. And it's highly industry specific. For example, software companies generally they don't have many assets and they have a lot of sales. And so they might have a lot of startup costs related to developing the software. But as soon as that software is developed, they don't really have that on hand anymore. They just have a bunch of sales. And then giant capital intensive businesses like airlines would have a very low asset turnover ratio because they need to purchase all the planes and everything. And so they have to have more assets for the sale in comparison to the total sales that they have. Sales discounts, there's both the net method and the gross method. Under the gross method, sales discounts is recorded separately, um, because management wants to record it separately, essentially. And then for this to be considered GAAP, it has to be netted out with sales eventually. Sales discounts reduce the amount of the sale. A sales discount is not an expense because if we have to offer 15% off everything to sell inventory, that 15% off, we never had that 15% to begin with, right? That's not an expense. That's just a discount that just reduces the amount of the revenue of the transaction. So the net method is the GAAP method to record. The gross method can be recorded, but it has to be changed to the net method for actually being put on the financial statements, right? That sales discounts has to net out to sales eventually for it to be considered GAAP. So the periodic inventory system, this is a different, we went through the perpetual method so far, recording everything as we go. The periodic method, also on the homework, is slightly different. We have different accounts. We have purchases, purchase returns and allowances, purchase discounts, and freight in as expenses. And it's easier to explain with this image right here. So under the perpetual method, we do not record as we go. All we record, we don't record in the perpetual method, we have every sale, we have a sale journal entry and a cost of goods sold journal entry. Under the periodic method, we don't have that cost of goods sold entry. We only have the sales entry. Then at the end of the period, we make an adjustment for what the cost of goods sold is. And so the basis for this is we know our beginning inventory. We know how much the purchases were during the period, purchase returns and allowances, purchase discounts. And then we have our total amount of net purchases throughout the period, which is purchases less purchase returns, less purchase discounts. Freight in increases the cost of our purchases. And then total cost of merchandise purchased is 527,000. That's all of our purchases, less discounts, plus freight. Then we add that to beginning inventory, and that's the total goods that were available for sale during the period. Assuming that like nothing was sold, that's how much we would have on hand. And then we do a count at the end, much like the shrinkage count. And we take goods available for sale minus ending inventory, and we get the total cost of goods sold before estimated returns. And that's the amount, that's that like, at that point, cost of goods sold is a plug. We calculate cost of goods sold based on how much inventory we know was sold because we know what we should have had there been no sales. We know how much is left, so we know the total amount that was sold throughout the period. Then there's a small adjustment for estimated returns inventory, which estimated returns inventory, right? It backs out the sale, it backs out the cost of goods sold. So that reduces our cost of goods sold. And we have our cost of goods sold of 520,000. And so how is this actually done or recorded from a journal entry perspective? We have these journal entries right here. So when a purchase is made, we debit purchases. Instead of debiting inventory, we debit purchases. And then we credit accounts payable. When something is returned, we debit accounts payable and we credit purchase returns and allowances. And when we pay for the inventory, that's as normal in the fact that we debit accounts payable, credit cash, but it's different because we credit purchase discounts for the amount of purchase discounts. These are all recorded. They all have their own T accounts, their own general ledger accounts as temporary accounts. These are all, instead of recording everything to inventory in the moment, we have all of these temporary accounts that eventually get closed out during closing entries to calculate what cost of goods sold is. So Purchases will have a debit balance, but purchases returns will have a credit balance because it's reducing cost of goods sold. Purchases are increasing cost of goods sold because it would generally be an increased inventory, but it's a debit in the natural accounting cycle because debiting purchases, crediting accounts payable. Um, Accounts receivable is a debit of 12, right? The initial sale, right? We debit accounts receivable, credit sales, but there's no entry for cost of goods sold because we're only calculating cost of goods sold at the end of the period in the periodic method. And why do companies do this, right? Like why it it makes it a lot easier for bulk commodity companies. That's really the main group that uses this is if it's an oil company, it's pretty easy for them to know how much are they purchasing, purchase returns, purchase discounts, and then they record the sale as the actual cash that they're getting or account invoices that they're generating for the sales. And then it's also quite easy for them to just measure how full is the tank of oil at the end of the period. Then they know what is their ending inventory. And then they can do this method quite easily rather than recording inventory in and out every single transaction, every single day, pumping oil in and out of the tank. So it's a lot simpler for bulk, whether it's grain, whether it's oil, whether it's a lot of big, it's a lot easier for them to record it in this way. Um, Whereas a retailer, they have to keep track of inventory on a SKU level on a daily basis, no matter what. So it's easier for them to use the perpetual method because they're already doing all the work to use the perpetual method. Giant commodity trading companies are not. So so they purchase more inventory if there is freight related to the purchase. For example, if they're purchasing inventory FOB shipping point, the buyer is responsible for the freight. They have to record purchases for the amount of the inventory that was purchased, freight in a debit of 750 for the amount of the inventory, freight cost, and then credit accounts payable. Collecting accounts receivable is the same, and then cash. Cash sales, we have the sale entry, but not the cost of goods sold entry. Then at the end of the period this is what the income statement essentially then looks like a worksheet almost, where we have beginning inventory, purchases, freight in, total cost of merchandise purchases, total goods available for sale or inventory available for sale, less ending inventory, less estimated returns inventory is our cost of goods sold. These also purchases account that's an activity based account. And so that's a temporary account then. And that has to be closed out during closing entries because purchases as an account just shows how much inventory was purchased during the period, how much freight was paid for during the period, how much purchase returns and discounts were done during the period. And so that all gets closed out in closing entries. And we also, in closing entries, we have our beginning inventory as a credit in closing entries and our ending inventory as a debit in closing entries because this change in inventory impacts our cost of goods sold under this method. And we could either debit or credit the change in inventory, but in these examples that we're going to be doing this week, we credit beginning inventory and we debit ending inventory. And what this does is it adjusts ending inventory to the amount that we counted that was there. Because if we reduce the beginning inventory to 0 and then we debit the new balance, it's going to be the new balance. And so then the inventory is correct at 62,000 at the end of the period. I know I went really fast on the periodic method, but that was intentional because the perpetual method is much more detail oriented and much more mechanical. And if you know the mechanics of the perpetual method, the periodic method can be conceptually more intuitive. I have a video going over both that you guys can watch as you're doing the homework. And of course, come to me or Stuart with questions. So that does anybody have any questions on this before we wrap up? Great. Get home safe.